What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be going over 5 solid dividend stocks. These are all stocks that I own, and I'm going to give my analysis and my reasoning on why I am bullish on these stocks. So, number 5, we're going to start at number 5, and that company is going to be Cracker Barrel. So, this is a company I started buying a couple weeks ago. The stock is down, let's say over 40% from where it normally trades. And Cracker Barrel is a dine-in restaurant that has most of their locations are right off the highway, and I think that's one of the benefits of this company is that they have really good locations. Most people you talk to will tell you they like their food, so I think they have a pretty good reputation. And as you can see, I bought 18 shares at an average cost of $97 a share. If we want to get more into it, we can look at Google Trend searches over the last 5 years, because some people might say, oh, a restaurant like this is going to have problems while we're in a recession or while we have, inflationary periods. But as you can see from the searches, it looks like things are just like normal, how they normally are. So I don't really see a problem with that. The dividend on this company is very intriguing, 5.2%. And if we want to look at their payout ratio, we can see here, if this will load, the payout ratio, I believe this is why the stock is down, is because they're kind of having cash flow problems at the moment. And that's part of my thesis going into this, is that I think those cash flows are going to return to where they once were. There's a lot of inflationary pressures hitting companies like this with their supply chain and with their products. So I think this is going to be a very temporary thing. But if we go back and look at where their income and cash flows normally are, so it says payout ratio of 104%, not the best. We want it like under 70%. If we look at their cash flow here, though, we can see, so in the long run, it goes up, right? It gradually goes up. But lately, it's been just very mediocre, right? Not the best. If we go back, why wouldn't it let me go back? Oh. So if we go back to net income, you can see here, let's see. That net income is, it's not horrible. It's back to those like 2013, 2014 levels. Not really ideal. We want to see it get back up to $60 million a year in net income. So I think they have a great chance of doing that. I don't think this is a company that's going away anytime soon. So I'm not too worried about that. I think I'm going to see some share appreciation from this as well. So not only am I getting a 5% dividend, but I think the stock's going to go back up to $140. Okay. The other thing that you always need to look for in a stock, just in general, is that the share count is not going up. And as you can see here, the share count has been fine. From 2007, it's pretty much, from then till now, it's pretty much been the same. And they're actually buying back shares. As you can see here, over the last 5 years, it's gone down 2%. So that's just more upward pressure for the stock price. So that's number 5. I'm very happy to own Cracker Barrel. Let's get into number 4. Number 4 is going to be one that's dealing with lots of legal issues right now, and that company is 3M. So I bought this stock in my other portfolio. It's not going to show up here, but this stock is down, let's see, I want to say at least 50% from where it normally trades. Yeah, right around 50%. So this stock is now $126. I believe I bought in right around 130 or so, and this company pays a 4.7% dividend, a PE ratio of 11, and a market cap of $70 billion. If you don't know, 3M manufactures tons of different products in industrial, safety, and consumer. This includes things like Scotch tape, things like hard hats, and things like earplugs. And what this is kind of leading to is that they're having lots of legal problems with the chemicals that are involved in their manufacturing. So, and I was 60s where they would dump chemicals and they would get in trouble for it. And, now there's more and more cases coming out about these things. What's going on? About these things being linked to cancer and health issues. And so they're having to pay all these legal fines. They're having to shut down the way they run, their part of their business. And so that's why the stock is down so much. But as we can see here, one of the latest cases is with their earplugs. They're spending over $450 million in legal costs because they sold earplugs to the United States military, and supposedly it damaged their hearing. So that's $500 million gone right there. Then we have other things like 3M manufacturing to stop making forever chemicals. This is another case where it's going to cost them over $2 billion. And because those chemicals are linked to cancer and other health issues, which is totally understandable, and they should stop doing that. But at the same time, I don't see this stock going out of business or anything like that. I think 3M is going to be just fine. This is not an easy company to replicate. It's not like somebody can just come in and take over making all those products. I think, and 3M has been around since 1902, to over 120 years old. So I think they're going to be around for quite a bit more. So I'm not too worried about 3M. If we want to look at, let's see, their payout ratio and their share count, we can see here that 3M has a payout ratio of 52%, which is perfect. That's perfect. A PE of 11, forward PE of 11. And then we can go down to shares outstanding to find that they're doing an excellent job buying back shares. We can go back, let's say the year 2000, when they had 790 million shares. Today, they only have 568 million shares. So I'm happy with that. And that is why 3M is number 4 on the list. Now, number 3 on the list is going to be something a little bit different. This is one I started buying last month, and this is SPYD. So this is an ETF based on the S&P 500. So it's not very volatile. As you can see here, the price doesn't really move. 5 years ago, it was 37 bucks, and today it's 40 bucks. So it doesn't really move much unless we have some huge, crazy drop like we did during the pandemic. But it's going to come back to this because it follows the S&P, but it pays a high dividend yield. And so I put 100 bucks in to see what I would get, and I got paid $1.27 in dividends. At first, I thought it was a monthly dividend. Then I found out it's a quarterly dividend, which means it's about 5% of a dividend yield, which is fantastic. That's really good. And so this is just like a safe place to put your money. Now, if you wanted a little bit less, if you wanted really close to zero risk and willing to accept a little bit less of a dividend yield, I would just put my money in Robinhood. Like, just, this cash balance I have sitting in here right now is earning 4%. I think you have to have Robinhood Gold to get that, but that only costs $5 a month. So you get Robinhood Gold, you put cash in your Robinhood account, and it pays you 4% interest every month. So that's almost just as good. If you want to get 5%, then it's a little bit riskier putting it in here, but not by much. Either way, I think it's good places to store your money, especially right now when we're in very uncertain times. We don't know how long a recession is going to last. When is the economy really going to get better? This is a good time to stack up on cash and safer investments, especially when you can earn 4 or 5% on those safer investments. Getting into number 2, we have Verizon. This is one where I think a lot of people are going to disagree. I've seen some backlash from this, but Verizon, part of this drop in this stock is because Warren Buffett sold. And, we don't know what he knows exactly or what his reasoning was behind it. I love Warren Buffett. I think he's one of the greatest investors of all time, if not the greatest. But I think he's lost his game a little bit in the last couple of years. He's made a lot of mistakes. So I don't invest based solely off of what he says. So Verizon, one of their main problem right now is they're having trouble growing the number of users. Keep in mind, they're the number 1 most used carrier in the country. So they have 200 million users or something. Let's see if it will tell us. They have, I forgot how many, but it's an insane amount. Okay, so that's why they're having trouble growing, because they pretty much have everybody. They pretty much have everyone in the United States pretty much has one of these services by now: Verizon, AT&T, or Comcast. So that's one part of it. If we want to look into the stats here, it trades at a P ratio of 9, a dividend yield of 6, which is huge. And if we want to look at the payout ratio, Verizon's payout ratio is 56%. Phenomenal. That's what we want to see. And what else? Shares outstanding. How is this looking? Not good at all. Well, it doesn't look good based off of the long-term chart, but to think about, they haven't issued shares since 2014. It's been 9 years now, so that's not a big deal. And I think they bought out a company here at that point. So they haven't issued shares in the last 9 years. That's not a big deal. I wouldn't be concerned with that. If we want to look at the valuation, let's see, the PE ratio. Well, this is kind of throwing things off, but yeah, that's throwing things off. Okay, how about this? So based off price to sales, it's pretty cheap. And based off price to book, it's pretty cheap. The stock is down so much, and I think it's going to go back up to $50 or $60 a share, maybe $55 a share. And I'm getting a 6% dividend yield for one of the safest companies out there you can get. So I'm not scared about this one either. I think this is a solid company. Let's see how many users this company has. I've also learned, so let's see, 143 million subscribers. Okay. I've also learned before that Verizon owns what's the word? The wires in the ocean, the cables, the phone cables that are in the ocean laid underground. Verizon owns those, and all the other networks use Verizon's cable. So I thought that's interesting too. I think Verizon is too big of a company to go under anytime soon. And I'm going to keep an eye on it. You don't want to put too much money into any one stock, but so you got to find the right balance. But I think Verizon is a safe bet. Now, getting into number one, we have one of my longtime holdings. I've had this for a couple of years now. Walgreens, another stock that's trading down. I think it was at a 5-year low, I want to say. Let's see here. And Walgreens is a pharmacy and retail store that, as you can see, I bought in quite early here. Average cost of $46 a share. I'm down 22%. Yeah, we're at a 5-year low here. And this company pays a 5.2% dividend, $31 billion market cap. And it started running up a little bit and went to $41 a share. And then now it's started coming down again. So I think I've slowly been buying shares. If it comes back down to around 30 or 32, then I'll buy more shares, because I think this is a very safe company to invest in. And I'm getting over a 5% dividend yield. So I'm not worried about this company either. If we want to look at this company's statistics, we can see here a payout ratio of 38%. That's the best one we've seen yet. That means they have plenty of room to afford a dividend. P ratio of 7 is so cheap, it's unbelievable. And this is another company where it's like, what's the chance of Walgreens going out of business? I don't see it. Then we can look at shares outstanding. Shares outstanding are down. That looks great there. And yeah, I don't see too big of a problem with this company. Let's look at their cash and their debt. So very high capital leases with relatively small amounts of cash, but we're talking over $4 billion of cash. Again, though, I think this is a safe business model. It's really just Walgreens and CVS. People say Amazon is a threat, but they've been saying that for years. And, Amazon, they're successful in a lot of things, but it doesn't mean they can do everything. Even, it doesn't mean that they're going to be able to do what a Walgreens or CVS can do. And Walgreens, they're on every single corner. I don't see this company going under anytime soon. And so it's another company I feel safe investing into. So those are my, last but not least, we have a bonus. This is a bonus one. This one I bought a couple weeks ago too. Almost made the list, but we're going to put it as a bonus. That is Hasbro. This company owns Dungeons and Dragons. They own Nerf. They own Play-Doh, and they own a bunch of other toy companies. They own Monopoly. They have like a Transformers deal. So this is another stock that is down a lot. I didn't get a chance to invest that much into this. I put $1,000 in, and then a couple weeks later, I'm already up 9%. So I don't know if I want to buy more right now or wait to see what happens. But as soon as I bought it, it started going up. So Hasbro's down at almost at a 5-year low. This company pays a little bit over a 4% dividend, P ratio of 21 right now, $8.8 billion market cap. And if we want to get into the specifics, here we will see. Oh, also I pulled this up. Where is it? No, not this. I guess I took it down, but the popularity for their brands are pretty consistent. Let's see. Payout ratio of 91%, kind of high. So not the greatest, but I think that's because they're having a bad year. Shares outstanding. Last time they raised it was 2019. So that's probably because of COVID. It's probably because of COVID. But overall, that's not a horrible chart. That looks okay to me. So yeah, Hasbro is the bonus. This is another one I bought. Right now, I would say it's still not a bad price because I think it's coming back up to $80 a share. So not a bad price, but if it comes back down in the 50s, I'll probably buy more. So yeah, those are my 6 strong dividend stocks. Thank you for watching, and let me know down below what your opinion is.